everyone. Thanks for being here tonight. Tonight we have a fantastic event called Just Raise a Fund, presented by Jerry O'Brien. By way of introduction, Jerry O'Brien has over 25 years of experience. He's the current CEO and Chief Investment Officer of OSP. Prior to founding OSP in 2010, Jerry was a founding partner at Carvel Investors, where he managed the global loan portfolio. Now the OSP team wants to make some further introductions, so I'll go ahead and...
We'll handle that later, but thanks, Blake.
Yeah,
that was great. I like the way you introduced me as the current CEO. It's the way my wife always introduced me as her first husband. As Blake mentioned, I am Jerry O'Brien, and it is really a pleasure, guys. Thank you for inviting me back to campus. The name of this presentation, as Blake said, is Just Raise a Fund, but you need to say it this way. You need to say, just raise a fund. And the reason I say it that way is, show of hands, any of you sit on or in close proximity to a trading desk before you came to Booth? So, you know, about once a year, people get upset or pissed off with their bonus, and they turn to the guy on their left or their right, and they say, you know what we ought to do? We ought to just raise our own fund. And they always use the word just. And the word just seems to kind of reveal that they have no concept of what a big deal it is. So anyway, I'm Jerry O'Brien. I have a couple of coworkers here that I'd like to have an opportunity to introduce themselves. And we'll start with another GSB Booth alum, Hugh.
Hi, I'm Hugh Cameron. I'm a managing director on the investment team at O'Brien Staley Partners. I joined as a summer associate in 2012, so I was in the full-time program here at Booth. Graduated 2013. I was active in the credit club at that time. It was called the Dirge Club. It's been renamed. It was Distressed Investing Restructuring Group. Somebody got the bright idea to rename it afterwards.
Somebody took marketing.
And then prior to Booth, I worked on the investment team at Travelers Insurance.
Good afternoon, everybody. My name is Alyssa Cheatham. I'm Director of Investor Relations at O'Brien Staley Partners. So my role involves working with all of our LPs, keeping them up to date on anything going on with the firm, with the funds, with performance. Prior to joining OSP, and I joined a little over a year ago, I had a similar role at Wells Fargo Asset Management. And prior to that, I spent about 20 years in institutional investment consulting, working with similar investment pools like many of our current LPs, healthcare entities, endowments, foundations, and corporate and public pension funds, which is actually how I met Jerry back in 2011 when I was doing due diligence on OSP Value Fund 1. Importantly, and kind of relevant to the reason that I'm here today, I spent 4 years prior to all of my work experience in Hyde Park as an undergraduate at the University of Chicago, and I got my economics degree.
Perfect.
Hi, everyone. My name is Kate Hurley. I'm the marketing director here at OSP. I work on the brand image, and I streamline everything through all the different departments on and offline. I came to OSP 2 years ago, and prior to OSP, I worked at an advertising agency in downtown Minneapolis.
But what you're missing, the most important part, is Kate is paying for the beer after this presentation.
Yes. Please join us after for the reception.
I'm Jill Worabi, and I have the privilege of being the Director of Talent Recruiting for OSP. And I met Jerry in 1994. We were both working at Cargill, and we had similar thoughts about how to evangelize and hire people and how much fun it is. So I retired from Cargill in 2017 after 6 years. And I can't even count it by months. And Jerry called and said, hey, why don't you come and talk to us about MBA recruiting? I'm like, okay. And it's been just the best, just absolutely the best. So I'm really fortunate, and I'm happy to meet all of you guys. And I know you're going to enjoy Jerry's talk.
Thanks for the introduction, Jill. Jill's, if you haven't met Jill yet, Jill is really one of the very best of breed in terms of talent recruiting, and maybe talk to her at the reception. Jill, before you joined us, I think 522 MBAs you recruited for Cargill. Those are the successfully recruited, not to mention. So a career of recruiting, and she really takes it one MBA at a time. And as we always say in the recruiting, which this is not about recruiting, but we always say it's not a spot market, it's a futures market. So she's genuinely interested in getting to know you. The probability that Q4 of 2021 or Q1 of 2022 is when our business need and your career aspirations meet is not as large as in the next 3 years. I bet there's something that you're interested in and we're interested in. So Jill is one to definitely keep track of. Okay, thank you guys for introducing yourselves. I mentioned I'm O'Brien. Maybe some of you are wondering, who is Staley? And you know, Staley is Warren Staley. Warren is the retired chairman and CEO of Cargill Incorporated. Warren worked there for 39 years, the last 10 or 12 years as the chairman and the CEO. And as you heard, I was at Cargill for 17 years. So I always, he was my chairman, if you will. There were a number of other chairmen while I was there, but Warren was the bulk. And I always loved working for Cargill. I always thought that Warren set the tone at the very top, and it was a great place to work and to build a career and to be associated with. So when they announced his retirement at age 65, which is the mandatory retirement age for Cargill, I made it a point to go to his retirement party, which was general admission. Everybody in the firm was welcome to pay their respects. And there was a long receiving line, almost like at a wedding, and I dutifully waited to get up to the front. And I'm shaking Warren's hand, and I'm sharing that sentiment. Thank you for setting the tone. I have always loved representing the firm, being associated with the firm, in large part due to the tone you set at the top. And as we're shaking hands, he says, "You're welcome." He holds my hand a little bit longer than normal. And he says, "Let me know if you ever want to do anything entrepreneurially, won't you?" Well, yeah, of course. Not what I was expecting at his general admission. I said, "Of course I will," and I let him go, and I'm making my way as other people are coming up, and I'm kind of crowing my neck. I'm wondering, is he saying that to everybody? Is he really upset about mandatory retirement age of 65? And he wasn't. This was just a seed planted in one particular place. And so didn't think too much about it. I mean, I didn't forget it, but I didn't think too much about it. 8 or 9 months later, my wife Lisa and I are at church, and I see Warren and his wife Mary Lynn across the church. And at the end of Mass, I catch up with him, and I ask him, "How's retirement going?" He's got a spring in his step. He's 65 and a half years old. The weight, the 39-year weight of the Cargill multinational is off his shoulders. He was also the chairman of he was on the board of directors of U.S. Bank Corp and chair of their audit committee for 10 years. And the first time they went through Sarbanes-Oxley, but he didn't have that responsibility anymore. And he was on the board of Target Corp for a while. You guys might not remember, this is almost economic history, but Target Corp had this giant data breach, one of the first major data breaches. Well, that wasn't his problem anymore. And so he repeats this seed planting invitation in front of his wife and my wife. If you want to do anything entrepreneurial, you'll let me know, won't you? And his wife, Mary Lynn, had this kind of little twinkle in her eye and a little head nod that I've never had the courage to ask. But I think she was saying, "Get him out of my kitchen. He has too much energy," right? And as we're walking away, my wife, Lisa, who has a PhD in psychology, she punches me in the shoulder. She says, "That's what an invitation looks like. Why don't men ever know when they're getting an invitation?" And I said, honey, I know. I mean, he said it 8 months ago. 8 months ago, and you haven't done anything. I said, well, it wasn't an invitation to do a deal or to do a trade or to raise a fund. It was an invitation to create a firm. And I said, I got to get my head straight on how to do this. But I did, and I created a little PowerPoint presentation. I went back to Warren with a business vision that became O'Brien Staley Partners. As I mentioned, Warren was at Cargill for 39 years. He was the retired chairman and CEO. It was really important to Warren that he not be perceived as raiding the firm or doing anything unseemly in terms of recruiting me away, and he didn't. He just planted a seed. And it was important to me that after 17 years that my exit be graceful also. I was also keenly interested in getting my investment track record. And so in quiet negotiations with the firm, it was agreed that if I served out a 2-year non-compete, I would be rewarded with my full attribution, 17-year investment track record, and there was a $3 billion track record. So that's a pretty good trade, and we agreed to that. And so I left Cargill basically 4th of July 2010 with a 2-year non-compete. And anyway, what I'm going to share with you today is the journey and the story and the lessons learned and some of the chuckles we've had along the way as we were raising our very first fund. We're on Fund 3 and aiming for Fund 4, not too far off. And so, we're going to give you the story, and I hope that there are lessons learned. We have some materials that we passed out. I saw a lot of you, looking at them and reading them, and I'll refer to them a little bit. But before we go that far, I want to, I promised our compliance officer that I would torture you all with this form. And relax, it's kind of like renting a car. You don't actually have to read this. Just initial here and here and here. This is for informational purposes only. You're not invited to invest. Past performance is no indication of future performance. It's funny if you've ever worked in a regulated environment. Many of you have. Your emails and all your presentations, all your materials have to be previewed for compliance. And this is actually an encore presentation. I gave this presentation here at Booth in 2017, and I think I've done it once again since then. And so this is maybe the third time giving this same basic message. The first time I sent it out, we have a description. It's just raise a fund. How often has someone been pissed? And when I use the word pissed, our internal system set off all these alarm bells. And people say, oh, you can't say pissed. I said, was that against SEC rules? It's like, no, it's not. So I said, well, I think I know my audience, and I'm talking about people not upset. I'm talking about people pissed, right? And anyway, so we sent it over to Booth, and I want you guys to know that your editors are alive and well. We were edited again, and so it said upset when you put the announcement out, which thank you for saving me from my SEC regulators. So anyway, okay, so there's a copy of this this is an email that I wrote to the internal staff upon our first successful close, and I followed this. This is the inspiration for this presentation, and there's 24 steps. Relax, I'm not going to take you through 24 steps. There's really 5 basic themes. There's having the raw ingredients. There's your proof of concept, franchise building, and then you get into brand evangelizing, reflecting, and repeating. So the very first thing you need to do is you need to have an office. This is our office in Edina, Minnesota, but there's kind of a fun story behind this. This was originally a multifamily, an apartment building about 3 blocks from my house. It was vacant and derelict, and I would drive to work at Cargill every day saying, boy, somebody ought to do something about that. And I'd come back from work and nothing, it was looking worse, and I'd go back and forth. And you never ever expect to see a non-performing asset in your own neighborhood, right? And it's like, oh my God, it's a non-performing loan right here in my own neighborhood. So I did a little bit of research. It was a 32-year-old, youngish realtor who got the condo convert bug in the late 08, 09 time period. And he hired an architect. And he didn't control the scope of engagement from his architect. That architect must have drawn pictures all day and all night because he ran up a $400,000 architect remodeling bill without ever breaking ground. And the architect attached it with mechanics lien, and so now he was underwater. He had a personal guarantee, he had some relatives' personal guarantees, and it was going nowhere. I looked up the bank, called the bank, bought the note, and then I called up the residential realtor, and I said, it's your lucky day. We're going to do a deed in lieu of foreclosure. He said, what's that mean? It means when the lawyers send over papers, you sign them and I release your personal guarantee. I said, good deal, like it, let's do that. So that's what we did. 3 days after I released his personal guarantee, I got a call from the Edina Police Department. Are you the owner of the property at 4121 West 50th Street? It's like, shit, man, it's the police. I was like, going through my head is there a dead body in the dumpster? What are the police calling me for? And I said, well, ownership is not exactly clear. And the police said, well, we just thought you'd like to know that there's water coming out the 2nd floor window. Oh, God. I don't know a whole lot about plumbing, but the 2nd floor window means the 1st floor is wiped out, right? And so we ran over there, and he hadn't paid his heat bill. All of the pipes ruptured, and it was nearly a total loss. But the the infrastructure was there, but you had to gut and redo the whole thing. I reached out to the building inspector in Edina, and I said, hey, this apartment building, it has a walkout lower level resident manager's office. If we convert that to a wheelchair accessible unit, can we put a private office upstairs? And the building inspector said, I'd do almost anything to get another wheelchair accessible unit. Yeah, let's do that. So that was the deal. And so this became our very first office, the top floor. And the interesting thing that I want you guys to take away from this is I was renting, it was rentals of residential rental on the ground floor. Upstairs, we were cash flow positive. We had no burn rate. And we were extending our runway for our ability to raise a fund. Now there's a second part of this story that's also kind of fun. This is actually my parents' house outside of Detroit in a town called Northville. And my wife, remember I told you she has a PhD in psychology? She thinks there may be an unresolved Oedipal complex that needs to be addressed. Okay, once you have your office, you need to have what I call a first follower. And the best way I've ever found to explain the importance of a first follower is a 3-minute TED presentation. Maybe you've seen it. It's gotten a lot of play. We love it, but I'd like to share this with you right now.
So ladies and gentlemen, at TED we talk a lot about leadership and how to make a movement. So let's watch a movement happen start to finish in under 3 minutes and dissect some lessons from it. First, of course you know, a leader needs the guts to stand out and be ridiculed. But what he's doing is so easy to follow. So here's his first follower with a crucial role. He's going to show everyone else how to follow. Now notice that the leader embraces him as an equal. So now it's not about the leader anymore, it's about them, plural. Now there he is calling to his friends. Now if you notice that the first follower is actually an underestimated form of leadership in itself. It takes guts to stand out like that. The first follower is what transforms a lone nut into a leader. And here comes a second follower. Now it's not a lone nut, it's not two nuts. 3 is a crowd, and a crowd is news. So a movement must be public. It's important to show not just the leader, but the followers, because you find that new followers emulate the followers, not the leader. Now here come 2 more people, and immediately after, 3 more people. Now we've got momentum. This is the tipping point. Now we've got a movement. So notice that as more people join in, it's less risky. So those that were sitting on the fence before now have no reason not to. They won't stand out, they won't be ridiculed, but they will be part of the in crowd if they hurry. So over the next minute, you'll see all of the those that prefer to stick with the crowd, because eventually they would be ridiculed for not joining in. And that's how you make a movement. But let's recap some lessons from this. So first, if you are the type, like the shirtless dancing guy, that is standing alone, remember the importance of nurturing your first few followers as equals. So it's clearly about the movement, not you. Okay, but we might have missed the real lesson here. The biggest lesson, if you noticed, did you catch it? Is that leadership is over-glorified. That yes, it was the shirtless guy was first, and he'll get all the credit, but it was really the first follower that transformed the lone nut into a leader. So as we're told that we should all be leaders, that would be really ineffective. If you really care about starting a movement, have the courage to follow and show others how to follow. And when you find a lone nut doing something great, have the guts to be the first one to stand up and join in. And what a perfect place to do that at TED. Thanks.
Well, I hope you enjoyed that. I think it's fun and profound. And I guess if continuing my metaphor, if Warren is the first follower, I guess that makes me the shirtless dancing guy. I showed it in the office, and a lot of people chuckled at it, and they said, "Jerry, are you in that video?" And I was like, "No, I wasn't at that concert." But there was a different concert. So Muffy McMillan is one of the heirs to the Cargill fortune, and she's very philanthropic, and she hosted a fundraiser for Opportunity International in her backyard. And she has a very large backyard. And she hired Kiss to perform. And Warren, Mary Lynn, my wife Lisa, and I, we all went to the fundraiser. We rode there together, and we kind of got separated. Warren was hanging out with the elder statesmen, and I was just having a good time. And unbeknownst to me, one of our lawyers, who was also invited to the event, pulled out his cell phone and videotaped me. Those are the security guards, and they're a good group of guys. They didn't know where the hell I came from, but I was enjoying the concert. There's, at the end of the concert, at the end of the festivities of the night, they shot off fireworks, and as most fundraisers do, they had a charity auction, and they auctioned off Paul Stanley's lead guitar, and raising funds for charity. I bid on and won the lead guitar. I then went, to pick it up, backstage. There's a little meet and greet. You have a handshake. You get your picture with Paul Stanley, and then I'm walking out with the guitar. And Lisa and I, we have no idea where Warren and Mary Lynn are, and we rode there in Warren's car, and so I'm looking around for them. And then coming from the other side of the stage and the setup is Warren carrying Gene Simmons' bass guitar. And so I paid $15,000. He got his for $14,000. He likes to tell me that I don't know how to negotiate. And so anyway, I think that's a nice extended metaphor of lead guitar, bass guitar, just happened that way. So, okay. So once you have your office and your first follower, you then need to work on securing your track record. And I shared the story of the non-compete and being able to secure this track record. We got full attribution of the track record. We were able to get the base data, take it to PwC, get it attested to under agreed upon procedures report. And it's a pretty good track record. It spans 17 years of investing $3 billion. And if you take any marketing courses here, which I highly recommend, you'll find that you should always have something that goes up and to the right. Any presentation, you better have something that goes up and to the right. And so once we had the track record all scrubbed up and attested to, it was time to start working on our message. And one of the earliest meetings I had was with a wealthy single-family office out of Connecticut. And if you've never worked with a family office, there's usually someone who's kind of a VP level, an MD level. You kind of go through this gauntlet, and then you get to meet with the executive, the patriarch, is always someone maybe called CIO, but the patriarch is the real CIO. And so you kind of go through this gauntlet, and then you get your meeting with the patriarch. In my third meeting with the patriarch, I was speaking, and I was talking about investing in credit-intensive loans, workout situations, management-intensive situations, orphaned assets. I'm 45 minutes into my presentation, and the patriarch holds up his hand. Just stop for a minute. What do you do? I was like, oh shit. I've been talking for 45 minutes and the guy doesn't have a clue what I do. It's game over, right? I mean, it's just the pleasantries. No patriarch is going to invest in something that he does not understand, right? So it's game over. You're just going to find your way out. And this was up in Connecticut, so I'm riding the train back from Connecticut to New York to catch the plane at LaGuardia to go back to Minnesota. And as I'm staring out the window of the train and things are flying by and I'm being introspective, I took lead. I'm a pretty good presenter. What was wrong here? What did I do wrong that he didn't understand me? And as I'm in this introspection, a billboard goes flying by. It's one of those garish yellow billboards that we all cringe when we see. We buy ugly houses, right? And it's like, look, we don't buy ugly houses, but there's no question what that guy does. We understand exactly what that guy does. And my message wasn't that clear. And so I started refining, and we came up with our message, which is we invest in unloved U.S. C&I loans, commercial industrial loans, in $5 to $25 million transaction sizes. That's our message. And I bring this up because as you guys contemplate creating your own fund, You got to get your message. And it's got to be something that is memorable and repeatable so that the patriarch doesn't stop you 45 minutes in and say, what do you do? And I would also say that it doesn't really matter how narrowly you define what you do, but when you get done narrowly defining it, you better be really good at it, right? And then really good will attract institutional capital. All right, so once you got your raw ingredients, you need to have a proof of concept. In my case, I had to have proof of concept that I could do what I had done for 17 years without the Cargill letterhead. So am I able to attract and retain a team? Am I able to source deals across business cycles? Will I see enough deals to be choosy and not have to win everything I see? And then can I have consistency of execution? So we got a couple graphs up here, the team, the org chart on the upper left. Down below are the 3 funnels where we source unloved U.S. C&I transactions across the business cycle, counter-cyclically, pro-cyclically, and acyclically in those three channels. And then we have our investment hit rate. So, and by hit rate, how many deals do we underwrite to how many deals do we consummate? And then, of course, profitable. But, you know, my long-run hit rate when I was at Cargill and Carval was 33%. 1 in 3 deals that we put time and effort, expense into, we closed. And why is that important? Because think about it, whatever you think my due diligence costs are, they're 3 times that. Because I got to pay for 2 lost deals for every 1 deal in the due diligence. And if you have a hit rate around 33%, that's sustainable. If your hit rate is 20%, you got 5 times the expense, right? So lost deal expense is the great thief of alpha in the night. And so being able to demonstrate, you know, a consistent hit rate that you're filtering your deals, seeing enough to filter, to get unique opportunities. And then, of course, you got to make a profit too. And that's the consistency. This is a little bit of a dated graph. This is the graph that we went to market with our first fund. And what you're seeing there is the control chart right out of Zvi Galula's class here at the Chicago booth. What you're seeing is IRRs on the top and the multiples. This is trade level detail. And this red line is an 8% return gross trade level. And this is a 1.0. What you're seeing is we started out 87 and 0. 87 of 87 trades were in the money. Now we're 11 years out. We've got less than a handful of trades that have lost money. So the consistency is what people need to see for your proof of concept at this stage of your development. Okay, once you have your proof of concept, you're ready to start franchise building. You know, you've recruited, now you need to deploy your team. I don't know if you can recognize alumnus Hugh Cameron there with these pacing through the airport. You need to start your brand identity, and this is what Kate works on. Brand identity. It's more than just choosing your name, your logo. It's every element and every facet of your brand. There's a lot of jokes around about all of the star constellation, all the Greek gods, all those names have been taken. We have one friend who launched a very successful firm, but they named it WMD. I'm like, wow, STD wasn't available? You know, okay. So you got to build your brand identity, and you have to echo it through all of your materials. Then you have to develop your policies and procedures, and not just write the policies and procedures, and not just plagiarize them from someplace else, but really talking about inculcating a culture where everybody agrees on it. Let me give you a couple of examples that I think everybody in our firm could tell you like this. When it comes to investments, one of our policies is, every deal that closes has a compromise. Some deals have 2 compromises, but no deal needs to have 3 compromises. When you get to 3 compromises from the defined ideal of what you're hunting for, reject the deal. There'll be another deal next month, next week. Always has been, always will be. You don't need to make 3 compromises. And I think our whole firm understands that, and we count, what is compromises from the ideal center of our bullseye. When it comes to risk management, we are in the risk-bearing business. We're not in the risk-avoiding business, but we don't bear unarticulated risks. So, it's incumbent on the investment managers that are presenting transactions to articulate the risks, to articulate corner solutions, downsides. If things are delayed 12 months, if collateral values are 20% low, how bad does that look? You articulate that risk, and then you're empowered to bear it. If you don't articulate it, then you're in trouble, right? And so that's kind of our core culture. So once you do that, now you're ready to register with the SEC. And this is filing out your Form ADV, and you are now live. You're in the game. Everything counts because people will come and look over your shoulder. And so that's the franchise building, and you're ready to go out and evangelize your brand. Now, when you're going to evangelize your brand, I know of 3 basic models of fundraising. Option number 1 would be to be incubated. There are some firms like Reservoir, and there's a number of others, who will take equity in your firm, 20% minimum, 25% more likely. Maybe they'll take royalties and equity, and they will plug you into their investor relations department and help you raise your first fund. Another model would be to hire a placement firm, and there's some great placement firms. There's First Avenue, there's Atlantic Pacific, Park Hill, Lazard. I'm sure I'm forgetting some other great names. And you can hire these firms, and you're basically renting a sales force to go out and represent your firm. And then the third way is to do it yourself, to build your own department for investor relations. When I articulated those 3 business plans to Warren said, well, let me see if I have this straight. If we get incubated, we give up 20, 25% of the equity in the firm, and after we raise the first fund, we're going to have to build out the department ourselves. Yeah, that's pretty true. If we hire one of these placement agents and we pay them, a commission, a placement fee, they're going to take 1 to 1.5 year of your total, AUM fees as their compensation. They're going to argue for tails on subsequent funds as well, and you're still going to have to build out the department yourself for the future. Yep, you are. And Warren asked the profoundly simple question, well, what are we waiting for? Why don't we just build out our own department? Well, because it costs money. But okay, we'll build out our own department. So when you want to recruit talented, gifted investor relations people, you might want to use a headhunter. And my experience with headhunters is they run out in the market ahead of you, and they are the very first impression the market has of your firm. So I was very concerned about who our headhunting firm would be. I'm using the word headhunting, I guess I should say recruiters or something like that. But so we interviewed 12 different firms. And there were firms from Minnesota, Chicago, New York, California, best of breed in the industry in terms of talenting investor relations. After talking about 9 of them, I kept hearing a very similar refrain. Jerry, you really ought to rethink whether this position is in Minnesota or New York, because there's deeper talent in New York. You're eventually going to have to come to New York anyway. Why don't you open up a New York office and we'll put a person in there? So I'd heard this like 9 times, and when I got to the 10th or 11th firm, I actually preempted and I said, hey, do you think I need to open a New York office to recruit this position? And the firm was Caldwell Partners, and Caldwell Partners said, well, Jerry, is that your business plan? I said, no, didn't plan on opening a New York office. They said, well, Jerry, you're supposed to tell me the business plan, and I'm supposed to fill your needs. I'm not supposed to tell you to change your business plan to meet the people I know. Wow, you're my guy. So we wound up hiring them and going through the recruitment. And we were looking for people who would stay with the firm and represent the firm. I use an expression, boardroom appropriate. Not too salesy. I don't want you to avoid the sale, but don't come off as a salesperson that's trying to hit it and quit it. And so we did, and now we have Alyssa, who's here, and we have Jen Goldsmith also, who she'll come out here on another trip someday, running investor relations. With the investor relations department, the next thing you need to do is to populate an Intralinks site with the critical documents. You're going to have your track record, which we already talked about. You're going to have your Form ADV, ADV2. You're going to have a flip book. You're going to have a one-pager. You're going to have a PPM and an LPA. And then the critical, I believe, the backbone to everything is the DDQ. And that's why we put a copy of a DDQ with a couple of the questions answered, but most of them just there for your benefit. That's a gift from us to you. If you're actually thinking about raising a fund, if you start by being able to answer all the questions on the DDQ, all the other documents are derivative from those answers. The other thing that I'd like to share is, to the largest extent possible, try to always answer the same question the same way as you go out fundraising. You know, one nuance of difference in the way you answer an ERISA or a leverage or a subscription line, you know, think of this on a 7-year scale and with multiple investors, you need to comply with whatever you said to everybody. So it's really helpful if you only say it one way. So if you start with the DDQ and populate the rest of the items, that'll make your life a lot easier, and it'll really keep your burn rate and your cost ratios down as you go forward in, you know, the 7-year management of a fund. So then, you know, you have your documents, you go to market. This is actually our funnel of our very first fundraise. And a lot of people say, hey, how many LPs do I need to meet? How many meetings do I have, you know, to be able to raise $500 million? These are the actual stats. We talked to 1,282 different people in 478 firms. You know, there's 2 or 3 people in a firm. You keep track of all of them. Of them, 76 agreed to in-person meetings. 28 then did deep dive operational due diligence, and 20 of them invested in our first fund. So, you know, if you guys are trying to think about, you know, how much shoe leather do I need to put in, how long is it going to take? Well, it's kind of like a marathon. You don't know how long it's going to take, but the sooner you start, the better off you're going to be, and those are good ratios. I think our ratio is pretty good. Other people's ratios might not be that efficient. Okay, then it helps a lot to get that hit ratio if you think deeply about what kind of LPs do you want. You know, a lot of people say, hey, I don't care, you know, the bigger the check, the better. Well, you know, that makes you kind of inefficient. You're running around and not focused in your fundraising. And when we contemplated this at the very beginning, I shared with Warren and with our Chief Operating Officer, Adam Bernier, I said, you know, 17 years at Cargill, I have never lost sleep over any of my credits, but I've lost untold numbers of hours of sleep thinking about international tax compliance. And so, you know, if we're just trying to raise $500 million, I'd like to raise it in the United States of America. And if we're unable to raise $500 million from domestic LPs, the problem must be with us. It's not the depth of the U.S. capital markets. There's more than $500 million of capital out there. And so rather than flying off to Iceland or Singapore or Abu Dhabi to try and, you know, sell somebody that you don't have a problem, let's focus on our problems and get it. So that was the one thing that we did that helped with our efficiency, is we said, we're going to be a domestic fund. There's not going to be an offshore Cayman Island feeder, which, you know, made our life more focused and less complex, and reduced our operating costs, made us, you know, more cost effective. And so I did, however, want diversification. And so I tasked the IR team. I said, you know, I'd like you to get at least 2 public pension funds. I'd like you to get at least 2 endowments, at least 2 foundations, at least 2 multifamily offices, at least 2 outsourced CIOs. We called it Noah's Ark. And so that was what their task was. And we did succeed. We wound up getting 4 of the top 20 university endowments. We wound up getting 1 state and 1 municipal retirement system. We got a couple of corporate plans. We got 4 religious / hospital foundations, 1 Catholic, 1 Protestant, 1 Church of Latter-day Saints, 1 non-denominational. Figure we're getting our bases covered. And then you know, it actually wound up, what happens is these LPs, they know each other and they talk to each other. And so you wind up, you know, getting your Noah's Ark going. Our 20 LPs for our first fund produced 490, and then we retained 19 of the 20 LPs were retained to Fund 2. And then by the time we got to Fund 3, we had 34 LPs, and we're up to $1.8 billion of fundraising following that focused strategy. Okay, so you've raised your capital, And now you have to invest, harvest, repeat. Harvest, report, repeat. Invest, harvest, report, repeat. And so it's really important that you continue to maintain those relationships that you've built with employees and potential employees, with LPs and potential LPs, with counterparties where you're sourcing deal flow transactions, and the regulators who you're trying to have a friendly and agreeable relationship with. But you're trying to do all that while managing the portfolio and the book. And so, what we've done is we've started to have events like this where we speak to potential employees, and we've also started to develop some digital media. What I'd like to show you now, got to get that up, is our firm's very first About Us video with a target audience of prospective employees.
In 2010, two accomplished figures in finance got together and took stock of the investment landscape. What did Jerry O'Brien and Warren Staley envision? With their well-earned reputations for investment discipline, risk management, and corporate governance, they founded O'Brien Staley Partners to do something deliberate in investing. Invest in what they want, where they want, with whom they want. Jerry and Warren launched OSP with a curated team of seasoned professionals, considered the best in their field, and who shared their creative vision. Together, the team developed a following for seeing intrinsic value in unloved U.S. C&I credits when others didn't. From TARP securities of community banks in the wake of the Great Recession, to church credits when more traditional investors lost faith in their bonds, and from economic development loans when America's municipalities suffered deficits, to discontinued business lines like aircraft and yacht finance in the turbulent aftermath of bank consolidations, or power line service and high-lift rental equipment credits when commodity prices plummet, even Puerto Rican corporate credits when markets are spooked by the island's broken politics. OSP's long-term success in these neglected niches led to it being trusted by a broad spectrum of institutional investment partners, spanning university endowments, hospital and religious plans, municipal and corporate pension plans, and more. The trust earned through OSP's value investing expertise rapidly expanded to include impact investing, adding to an already impressive range of investment partners and accolades. The Wall Street Journal and the University of Chicago both published articles recognizing OSP for the significant contributions its impact investing is making to disadvantaged communities. These investments have fidelity to both investors and society by delivering consistent market rate returns and measurable societal impact. From real job growth to energy efficiency to intangible assets like civic pride, the impact is being felt all over the country. In similar fashion, OSP's nationwide loan servicer is thriving. AmeriNat's veteran team of servicing experts is reshaping their industry by supporting underserved communities, helping hundreds of clients across the country successfully manage their economic development and housing assistance loans. As it grows, O'Brien Staley Partners will broaden its perspective to span new asset classes and geographies, and continue to put forsaken opportunities on a solid foundation to derive benefits for its investors, its team, and society. But it will always be framed by the founder's core principles and its Minnesota roots. Step back, and the bigger picture is revealed. O'Brien Staley Partners has assembled all the pieces to realize its vision of a renaissance in investing.
I hope you enjoyed that content. If you go to our website, and I think, Kate, did we put the UR codes on the cover of that DDQ? If you go to our website, you can see some more content. And what you might find really interesting is some interviews we have with past summer associates or interns. And one of them is actually here. Tess, will you just introduce yourself to all your classmates?
Hey everyone. So my name is Tess Cross, or Tess Watson, as I was when I interned.
Sorry.
I was a fall associate with OSP, so I'm in the evening weekend program, about 75% of the way done. So may have seen some of you guys in classes, but I'm not sure how many of you make it to the night classes. But so yeah, I did an internship last fall and up in Minneapolis, got to live and see Dinah firsthand and work with this great team here. So nice to meet everyone.
Thanks.
Hope to see you around campus.
Thank you. So you guys have been very courteous audience. This is supposed to be a fireside chat, so I'm going to invite you guys, and Kate, you have a microphone. Anybody have any questions you wanted to that you've been holding back on? Yes, go ahead. Yeah.
Thank you for your time.
Yeah.
Brennan Hawkins. I'm in the second year in the full-time program.
Yeah. Hi, Brian.
I'm curious about, you mentioned the importance of the track record,
Yeah.
and I'm curious about the nature of investments you were making at Cargill. As I understand Cargill, it seems like, I don't know, that were they of similar nature to what you're doing at OSP?
Yeah.
And then I'm curious about sort of how you defined your thesis and came to that strategy.
I'm going to back up and talk about the thesis, then talk about Cargill. The short answer is yes, consistent. Of my $3 billion track record, $2.4 billion was in unloved U.S. C&I loans over 17 years while at Cargill. $600 million was either non-C&I or non-U.S. Investments. Investors, when they do operational due diligence, they want to see everything you ever touch. So you show them everything, not just the thesis, but everything else, which gives them comfort. My thesis for unloved U.S. C&I loans, I was here at GSB booth, and everybody gives the efficient market hypothesis, well, efficient markets, not the efficient market hypothesis, efficient markets and the Fama-French school of thought, a lot of, it's out of favor right now, right? But I think that those are people who don't realize that the thesis starts with, if markets are efficient, then ... And I believe that if markets are efficient, ... can I find an inefficient market? And so, the market for unloved U.S. commercial industrial loans, it's not quoted, it's not traded, it is informationally inefficient, it is, sourcing inefficient, it is servicing inefficient, and it has chronic, uncurable inefficiencies in that market. I started my career, so I grew up in Michigan. I went to the University of Michigan undergrad, and my first job was at Chemical Bank in New York, which is now JP Morgan Chase. I was 22 years old, and I was classically trained in credit analysis. And I'll be forever grateful to now JP Morgan Chase for investing in a 22-year-old kid, the lifetime skill of credit analysis. And I saw what the market for loans is just not a quoted market. You turn on CNBC or Bloomberg or whatever, they're not quoting loan prices and things like that. So that's where my thesis came from. I guess it was consistent. So Cargill, maybe to you, is an agricultural commodity trading. I think in that context, and if people have awareness of the Goldman Sachs organization, they have a business unit called J. Aron. But there's an awful lot more to Goldman Sachs than J. Aron. There's an awful lot more to Cargill than just commodities. And so the Cargill Value Investment, which became Carval Investors, actually, when I left, it was about a $10 billion balance sheet investing in unloved commercial industrial loans. There was another business unit that did consumer and residential loans. There was out of favor real estate, and it was on 4 continents. So yes, very consistent with what I did and in a meaningful business unit inside of Cargill. Yep. Yep. Oh, yep.
Jin Tao Zheng, finance PhD and
Do you mind taking off your mask? Yeah, just for the question. Thank you.
finance PhD and MBA at Booth. And I have a question about you said that the importance of the first follower, and how can you talk about your experience about how do you attract the first follower, especially for many of the firms, and they actually would like to invest in you, but there's a coordination problem, saying that they actually do not want to be the first guy. They want to see that other guys. So actually, you need to solve a coordination problem. How do you solve that? Thank you.
Yeah. So how do you solve it? Well, okay. So in my case, Warren Staley is a first follower. And then there's another expression which I use. Have you ever heard of a bell cow? A bell cow is the first cow moving and wears a bell and starts moving, and other cows follow. And so besides finding Warren to be a substantiation of my skill set, Warren knew everybody managing everything at Cargill, and I was blessed that he chose me on. I think it was a combination of skill and character. But then you need to find an institutional investor who believes in you. And your can I mention? Are you? So he's sitting in the back of the room, actually. So Pete Belichko was actually the very first significant institutional investor, representing 1/3 of the portfolio at the Northwestern Endowment. Pete, is that about right? Yeah. And there was something about my niche that Pete, you want to give 60 seconds on it?
Yeah, we'd been investing in non-performing loans for a long time, but I think one of the things that was interesting about Jerry is that, and this usually is true when you meet people that are really good investors, is they actually teach you something that you didn't know from your last investment. So you're always learning. And so I learned a lot from Jerry. I learned non-performing, maybe not as smart as performing at a discount. So little nuances like that. But I think at the end of the day, you're looking for somebody that's the best at what they do and is extraordinarily and sincerely passionate about what they do. And so you see a lot of insincere people in my line of work. I've said no to 10,000 people. I've said yes to maybe 50. So all I do is say no. But I see a lot of insincerity, and I see a lot of fake people, and they're just looking to raise money. And I see a lot of track records that aren't real. And so when you see that all come together, I think in one place, you're willing to take a leap, and that's what we did. So I think a lot of other people followed.
Yeah, and thank you again for taking that leap. But one of the things that part of being it's hard to say being a genuine or sincere person when you're talking about yourself, but part of being genuine is recognizing that, hey, Pete has a very good position, and he took some element of personal career risk betting on me in a first-time fund. And so being grateful and appreciative, and never ever never have him regret having trusted the people, right? And so communication early in advance and all that kind of stuff. So I guess it's just you need to develop a genuine relationship with a first follower and a first institutional, bell cow investor. And I guess the only way to do that is by being yourself all the time. So, thanks. Yeah, please.
Hi, I'm Emily. I'm also a full-time second-year MBA student. Yeah. Following onto Jingtao's question in your answer, I was curious about when you think about the Noah's Ark, you've approached a lot of different types of institutional investors who will do their due diligence on you. How did you do your due diligence on them before seeing them to sort of figure out how to convey your message?
So there was one institutional investor who manages a state fund, and he has so many billions to deploy that he can't make a deployment of less than 100 billion. And he wound up being a really good counselor for me, but he'll only invest 100 million or more, and he doesn't want to be more than 10% of the fund, which means he's only in $1 billion funds, right? But I had a lot of good conversations with him. He had formerly worked at Cargill, and so there was a nice rapport there. And he made a statement to me: don't go to the investors saying, well, I could do this, or I could do this, or I could do this, or I could do this. He said, tell them what you're going to do. Tell them that you've thought about it and you've made this decision. You don't want to leave the institutional investors feeling like it's a negotiation with you. And if, should they stop negotiating or not? And so that was really helpful to me. The other thing is recruiting talented people like Alyssa, who has worked with LPs in a variety of different, I'm going to call them verticals or cohorts. Any more questions? Oh yeah, I'm sorry, right here. Yeah.
Thanks so much. Absolutely. So you were talking about the art of that, making a deal of how not to compromise too much. Twice at most. How do you come up with that bullseye? Exactly, that's where you want to be. and how do you quantify how far away you are from that deal?
Yeah. You know, one of the things I discovered when I first became a trading manager, earlier in my career, that people who were coming to you for trading authority, they would present an investment opportunity and they would compare it to the last deal that you approved. Right? They say, Jerry, this deal is just like the one you approved for me last week, only this and this are different. Okay, good. And then a week from now, they're going to come to you and say, hey, Jerry, this deal is just like the one you approved last week, only this and this are different. Well, now I got 4 compromises to where we started 2 weeks ago. And what we actually do on a quarterly basis is we articulate the center of our bullseye. What are we hunting for? What do I want the investment team to source? And it's, in broad brushstrokes, it's unloved U.S. commercial industrial credits. There's a little more specificity on types of collateral, on geographic preferences, and things of that nature. And as the chief investment officer and the chair of the investment committee, we refresh that bullseye quarterly. It doesn't get refreshed deal by deal, and there's only 2 compromises to the last deal approved. It's to the articulated bullseye. So we like to have cash flow positive, well secured in geographies that we have confidence in. We will accept that you can be undersecured, or you can be non-cash flowing, or you can be in a geography we don't like. But don't stack up 3 of those things, because that's 3 compromises away. And as you're getting those compromises, we price adjust. We're not going to bid as hard for a deal that isn't in the center of our bullseye. No. Yeah. Thanks. Okay. If there's, yeah. Oh, good. I love it. This is the point of the fireside chat. Thank you.
Hi, Angel from the full-time MBA program. I have 2 questions. They're quick. So were you raising only for equity in the first fund, or did you raise also debt? And the other question is, what was your strategy? Did you have any anchor investors in mind, or you were only seeking for all the money that came by?
So we run an unlevered fund that invests, so it's called a private equity structure, in that it's a 7-year lockup drawdown fund with 3 years to draw down the commitments, a 4th year of recycling, and then 3 additional years for harvesting. And you can deal with tails if there's a tail. That's called a private equity structure. Maybe you know this already. Not to be confused with a private equity investment strategy, right? So we use a private equity fund structure to invest in typically fixed income or commercial credits. Other people might do that investing strategy in a hedge fund strategy, which a hedge fund strategy typically is not a 7-year lockup. It might be a 90-day liquidity promise. And I find that to be an imprudent bet to buy a portfolio of yacht loans and tell someone I can give them 90 days liquidity. I cannot. And then I'm not certain if part of your question was whether we're running a levered or an unlevered fund. If that was what you're asking, we have deliberately chosen to run an unlevered fund. And my view on that, if you think about leverage, let's just say you have 3 turns of leverage, 75% debt to 25% LP equity. Well, to get the same AUM deployed, I have to do 4 times as many deals, right? And so I've found over the course of my career, if I look at all of the deals in the market and I only do 25% of what I see, I can get a better unlevered return than if I do all 4 of them and lever it up. And so we've been gratified with our unlevered return, given our ability to be selective. The other thing is I find that, if 75% of the money is for a bank, I'm working for the bank, and that's just not as much fun to me.
Were you looking for anchor investors, or were you not?
So I'm not 100% certain. Anchor investors. Yeah, so we articulated a strategy. This is a great detail question. The hardest thing to do is to herd all the cats and get 20 people to close on the same day. And nobody likes to close before there's some genuine scarcity of opportunity. And so we actually created cornerstone categories. And so you say anchor, we said cornerstone. And we defined our cornerstones. We said the first 50 million coming in from a endowment will get a discount on their fees. The first 50 million coming in from a public pension will get a discount on their fees. The first 50 million coming in from a foundation will get a discount on their fees. The first 50 million coming in from an outsourced CIO will get a discount on their fees. That means now I'm not raising a $500 million fund, there's a $50 million fund. And if you move quickly, you can get in on the discounted fees. If not, there's not going to be any more discount for you. And that worked really well for our Noah's Ark strategy. It was a genuine limited supply, and we held to it. We didn't give, beyond, So if we already had 40 million of subscriptions and you wanted to do 20 million, I've only got 10 million of discounted fees for you. I can give you 10 million of that and another 10 million at full fee.
Thank you.
Yeah, thank you. Yeah.
Yes, I'll just. Thanks for the session. I'm a first year full-time MBA as well. My name is Pranay. I think just following on Emily's question was when you have an endowment or a pension fund thinking of investing at the fund, what is the kind of diligence they would carry out? How long does it take for them to make the final decision? And could you also just walk me through the ADV filings with the SEC? How complicated is that, or is that fairly sort of boilerplate templatized?
I'll take the back end first. The ADV, there's two. There's the first form, the second form. They're all publicly available. You can download them. One of them is extremely bureaucratic, and it's, where are you incorporated? Are you in Delaware? Or, who are the owners? What are your fees and things like that. The other one is derivative of the DDQ. It's more of the narrative of the firm and the strategy and the history and the background. And it's out there to be discoverable by the public domain, for people. So you can.
It doesn't ask for a track record. The ADV filings don't ask for a track record.
I'm not 100% certain whether the track record's in the. My track record at Cargill, you saw what is approved for general consumption. Cargill's terms of use with me requires that it be protected by an NDA. So any LP that wants to see it has to execute an NDA, and then they can go on the Intralink site and see the full track record. So no, I don't think the ADV is going to have the full track record in it. The other part, I lost the other part of your question. I'm sorry.
Yeah,
it was.
So when you have an endowment or a pension fund looking, what is the kind of diligence they would exercise?
Yeah, the due diligence. It starts. As Pete shared, they are peppered with inquiries. They are peppered by placement agents who are paid sales force. They have their ears open. I guess the most interesting thing I learned in my career is that if you're dealing with not a large organization like Northwestern or University of Chicago endowment, but a more modest one that's like $1 billion, they have a fully diversified portfolio and a staff of, pick your number, less than 10 people. And so they actually run through cycles of when they're considering fixed income, when they're considering domestic, when they're considering international, when they're considering alternatives. And if you come to them when they're worrying about something else, they're not thinking about you. So getting on cycle with them is the first thing. There's a joke in investor relations. The point of a first meeting, the objective, is a second meeting. Guess what the objective of the second meeting is? A third meeting. Okay, and this is like the old, real estate location. What do you think the objective of the third meeting is? A fourth meeting, right? And so it takes a little while for someone who's coming off of a trading, transactional mindset to recognize these are not transactional people. They're working on, 7, 10, 20-year investment horizons. They have limited number of spots on their roster of managers they trust. And they're not in a hurry. And so trying to be in a hurry will be off-putting and won't succeed. Their due diligence, their operational due diligence is all of those questions right there. But it usually starts with, do they trust the management team? Do they believe the strategy? And then they do a lot of calling around behind the scenes to see who knows you and whether, is this true or is this untrue, what what I'm hearing about who you are and where you came from and why are you leaving now. Yeah. Yeah. Microphone. Yep. Thanks, Kate.
Thanks, Sherry, to you and your team as well for the time and making the trip tonight. Nick's already second year in the full-time program. I'm not going to ask you to divulge the secret sauce, but I'm a little bit more curious about the inefficiency in the C&I market.
Yeah.
And if it's related to a lack of information, which it sounds like it is, how is your team so kind of talented at getting that information, processing it, acting on it, and others sound like are maybe not as much, or there aren't as many players in this space yet?
So there are a lot of players, but a lot of players who have raised $5 billion funds. And so, there's an expression, won't cross the street for less than a $100 million deal. So by, being experts in our credits and our analysis and our counterparties, but sticking to the $5 to $25 million transaction size, that's defendable. It's larger than the country club investment crowd, and it's not big enough for the $5 billion, $10 billion, $20 billion. I think Oaktree just raised $15 billion. There's nothing in our trades that Oaktree wouldn't like except for the size, right? They'd like to have a larger size. This presentation is targeted at talking about capital raising and raising a fund. I gave a presentation at Rice, February of 20, and it's on our website. And so I go through in great detail talking about the trades and the sourcing of the trades and the underwriting of the trades. And it's another hour presentation. So if you're really curious, you can click the UR code and you can watch the Rice presentation. The name of that presentation is What Time Is It? But just like this one where you have to say, just raise a fund. On this one, you got to pretend like you're from Minnesota, like you're Morris Day. What time is it? And that's... How are we doing? Am I exhausting my crowd? Are you guys? Oh yeah, good. Yeah.
Thank you, Jerry. Can you hear me? Yeah.
Thank you.
Thank you, Brendan O'Brien, a second year in the full-time program.
I won't forget your name.
So my question maybe is a little bit substantive, but also related to how you deal with investors. Like the content that you show, you mentioned a whole bunch of different particular niches that are specific, and there's a lot of breadth there.
Yep.
Puerto Rican corporates to airplanes and things like that. So I'm curious if when you went out to talk to your investors the first time, if those were all things that were like in your arsenal that you were ready to do, or if some of those things came later, and to the extent that some of those things came later, what was the conversation like with investors to get them comfortable with branching out a little bit?
Yep. So Puerto Rico was definitely on my radar screen. The team I led made its first, and this was before O'Brien Staley Partners, the first investment in Puerto Rico in 1999. And we figured we had cracked the code of sourcing, underwriting, servicing, resolving profitably trades in Puerto Rico. So I definitely disclosed that. In terms of C&I, commercial and industrial, as a loan designation, that means loans that may or may not be real estate secured. If they do have real estate, it's related to the business, like a bowling alley, right? You're secured by a bowling alley, but if you're not running a bowling alley, it's not income producing real estate, right? And if you are secured by the bowling alley, I sure hope you have the liquor license, because that's how they make money, right? So a C&I loan is a business loan that may not have real estate collateral. So when you go to other commercial loans, for let yachts, it's a business loan, or aircraft, it's a business loan without real estate collateral. So it was consistent with our underwriting skill set, and yes, we had done it before, but your credit is credit. You're just substituting the collateral and the type of business or industry that you're in, but we stayed to our dedicated geographies. They were cash flow positive performing, and then knowing how to perfect a security interest with the Coast Guard is something that all the real estate crossover guys have no concept of. So that'll leave an inefficiency in that marketplace for you. Or perfect a lien on aircraft with the FAA. Real estate guys have never done that. Nothing they've done. So yeah, that's the. Thank you. You're welcome. Yep. So I think that it's time to invite everybody to the cocktail reception. We'll field all these questions and more, in the other room. I'm hoping you got the big picture, which is, you can't just raise a fund. You have to actually build a firm. You have to have the raw ingredients. You have to have the proof of concept before you go out and evangelize your brand to raise your capital. You have to have a business vision that's not just this trade this month, but the totality of a firm in order to raise capital. Then you have to repeat and continue and grow. And that kind of, I got a question a few days ago, great history in the firm for the first 10, 11 years. The next 10 years won't be the same success. It'll be a different success. And so my primary concern right now and why I'm here, and thank you for inviting me, is we need to know more talent to continue to grow. So thank you very much for inviting me in. Blake, thank you. Thank you to the Credit Club. And thanks to the University of Chicago for putting skill sets in me that have been very productive. And I'm happy to return the favor and help you guys anytime I can. So thank you. So Kate, the beer's over there? Yeah. Okay. Great.